Hi, my name is Thomas Cook, and welcome to today's Real Estate Minute. Today we're coming from Playa del Carmen, Mexico, and my guest today is Joan Galbianco, and she's a Vice President of Real Estate Secured Lending in Toronto for TD Canada Trust. So welcome, Joan. Thank you. So our topic today is longer than normal amortizations. Now, an amortization means that's the number of years that it takes to pay that mortgage off to zero if the interest rate was constant all the way through. In Canada, that's typically 25 years. Okay, so Joan, what's happening now? What's available in the marketplace?
Okay, starting in the fall of 2006, we've gone to 35-year amortization, and already within the first quarter of 2007, we're moving to 40-year amortizations. It's not for everybody, but it is for some customers.
Okay, and why are these so popular? Why are 35 to 40-year amortizations popular?
I think they're going to have a great appeal to first-time home buyers, people trying to get into the housing market. By having a 40-year amortization, we're not really extending the risk with that same customer. So if we gave them a $150,000 mortgage, for example, for 25 years, and now we can give them a 40-year amortization, all we're doing is allowing them to more affordably pay for the mortgage payment. I believe that most people will, for their first term, say the first 5-year term that they had, have a 40-year amortization. And as they move up in the income brackets and they also gain some equity in their homes, they'll eventually take that amortization down and pay down more quickly.
Great. Now, there's been a little scare recently in the U.S. where they have these subprime mortgages, and there's a couple of companies gone bankrupt because of it. I guess there's a congressional investigation going on about all this and so on. So do those subprime mortgages relate in any way to these longer amortizations that we're talking about?
No, the subprime market in the U.S. is quite different. The Canadian market is a completely different market than the U.S. In the U.S., about a quarter of their mortgages, so about 25% of their mortgages are in the subprime, which normally are some very interesting mortgages, interest only. Some of them have a couple of years of low rates, like in the 1.5% range, and then suddenly spike up after 2 years to much higher rates, and people cannot afford to buy them. All the 40-year amortization does is spread the payments of the current mortgage over a longer period of time.
At an equal amount.
So
nothing to do with negative amortization either?
Nothing to do with negative amortization. We're really only in a very small way in anything that's like subprime in the U.S. and Canada. Only about 5% of mortgages are subprime, and it's right now primarily with some small mortgage brokerages. It's not with the prime lenders, the big lenders, the banks. We're really not in that market.
Okay, so who would these longer amortization mortgages appeal to? What would be the sort of best case client for that?
I think young people today, they still want to have their lifestyle that they're accustomed to. A lot of people still want to be able to go on vacations and have new cars, and to have a longer amortization means they can enter into the housing market as well as have a pretty decent lifestyle at the same time. I think it'll appeal to new immigrants, give them a better opportunity to be able to afford to pay a mortgage. So I think there's a wide variety of people who could use the longer term amortizations, even for customers who possibly have some challenges from job, someone loses a job or there's an illness. Being able to move to a longer amortization gives them a better chance of being able to afford their mortgage.
And so even if you have that longer amortization where the payment is lower, especially with TD Canada Trust, that doesn't prevent you from increasing your payments at all, does it?
No, you can change your payment from monthly, bi-weekly, or weekly, whatever you want.
And of course with TD you can increase your, say, bi-weekly payment by up to 100% every year.
Yes.
Right? So what percentage of your business is now these longer amortizations?
We're just getting into the longer amortizations with the 35 years started in the fall. We're seeing, new mortgages coming on the book, but I couldn't say exactly what percentages. It's still relatively new.
Because we had a discussion today with the CMHC lender, and he was saying that almost 30% of their loans are now these longer amortizations. So they're obviously obviously quite popular for the general public.
Right.
In fact, the lender that we use from TD, George Christopoulos, he gave me a great scenario the other day where he was doing this for one client, and that was, it was a couple who were going to be having a baby within a year and a half. So they set it up for the longer amortization, figuring that when she was off on maternity leave and the pay was cut in half or whatever, that they would be able to keep affording these payments. And then as soon as she was back to work and her income increased, perfect. They could then easily increase the payments allowably without any penalty and get that mortgage paid off as quickly as possible.
Yeah, great example where you're down to one income for a period of time, and it gives you the opportunity to stay in your home, stay in the mortgage industry or stay in the housing industry, and still be able to afford it.
Great. So thanks very much, Joan. And that's it for this edition of the Real Estate Minute. Thanks for listening in.